Well, we saw a really nice read on inflation yesterday. We were down quite a bit. That was not expected in yesterday's report. So we're going to get into some of the details of that. How much did it help us? And why did we wait until Friday to publish this video? We're going to talk about that in today's video. So here's the reason why, y'all. There's two components to the CPI being released. It's always followed immediately with the producer price index. One is measuring the wholesale, the production side of inflation, which we got this morning. The other is in measuring the consumer, the retail side, that's based on what you buy and how much you paid for it relative to the prior month and the prior year. The CPI is the one that everybody looks at. It's not the one necessarily that the Fed focuses all of their attention on. So let's talk about it. The CPI yesterday came in down 0.1% in the headline number. It was expected to be up 0.1. So that was a 2/10 of a point swing in the right direction with regard to inflation. So that was very good news. We saw a very nice rally in the bond market as a result of that number. I waited until today to do this video though, because following the CPI is the PPI. That's the wholesale read on inflation, and it really gives us a back office view of that CPI number and some of the internals in it with regard to wholesale prices, and it can make a quick turnaround to what we see in the CPI. So I want to give you all the complete picture. I don't want to just do a reactionary video on one report without getting the full picture on inflation. And unfortunately, PPI took away quite a bit of the gains that we saw from CPI yesterday. We are still seeing interest rates quite a bit better, and we're going to look at those numbers in just a second. But PPI took a little wind out of the sails of that good CPI number. It was up 0.2 of a point. It was expected to be up 0.1 of a point. So we saw upward revisions in PPI, downward revisions in CPI. So those reports are moving a little bit away from each other. So it's a mixed bag on inflation. Not everything we wanted between these two reports, but still a significant positive read overall between the two reports. When you net these things out, y'all, it's a net positive for the bond market. Here are the numbers we are seeing as a result. We are sitting at probably 6 or 8 week lows with regard to interest rates. 6.82% is the national average according to Mortgage News Daily today. 1 week ago, we were at 7.03, y'all. So we are 1/4 of a point better in a week. That is a dramatic improvement from a lending standpoint. It's not a huge difference for a particular buyer. However, when you move 1/4 in a week, it's a big deal for mortgage people. We like it. When you look a month ago, we were at 6.98. So we are now firmly back in the sixes, y'all, for the majority of your buyers. If they've got passable credit, they're going to be in the sixes with regard to what rate they're going to be locking. And that's very good news, y'all. What's coming up on the calendar? Personal consumption expenditures. Now, that is the Fed's favorite gauge of inflation. That one cuts through a lot of the noise that the CPI and the PPI can have in them. That report comes out on the 26th of July. Now, y'all, the Fed meets on the 31st of this month. There are actually some folks out there prognosticating that the Fed may surprise the markets with a cut at the July meeting. I will tell you, the CME Rate Watch tool that I look at daily does not expect that at all. According to the CME Rate Watch tool, the 7/31 meeting has only a 6.7% chance of yielding a cut. However, the September 18th meeting is up to an 88% chance of a cut. That was in the 70s last week when we looked at that prognostication tool. We have a 97.7% chance of a cut at the November 7th meeting, and then a 99.7% cut by the July 18th meeting. So, y'all, markets are fully anticipating a minimum of a cut starting in September, and then the rest of the year, we may see cuts at each of those meetings. There is actually some folks prognosticating that at the September meeting, you might see a 50 basis point cut. That would be a surprise. The bond market does not have that priced in, y'all. We are expecting a 1/4 point move at that first meeting. And beyond that, the bond market's not expecting or pricing in a lot of expectation for any shockers to the marketplace. So if that were to happen, we would see a really substantial pop lower in interest rates. So let's keep eyes on that. Y'all, part of what's driving the Fed's desire to take a second look at cuts this year, being more aggressive, is the weakness in the job market that we're starting to see. When you look at some of the internals of the BLS reports that we've been looking at on the first Friday of every month, the revisions to those reports have been frankly ludicrous. We are averaging now 50,000 additional job losses in the revisions to those reports versus the headline numbers that come out. We're talking over 500,000 additional job losses in 2023 compared to the reported numbers, y'all. The Fed is starting to realize that the BLS report is just not a decent gauge. They're going to have to look at some that are more backward facing to look at more actual data and do their own math with regard to the labor markets, because it is significantly softer when you get into the actual numbers than these BLS prognostications. So Fed's onto that, and we are seeing some language that indicates they're going to be more aggressive. So y'all, are we starting to see the fuse lit for cuts? I think so. More to follow. You have all of my contact information on the screen. Always blessed to have your referrals. Be blessed, stay safe. Talk to you next week.